before you bought that was lay off $20 billion or so of it before you buy the $39 billion in real estate, and that was a real challenge, and I think it was really a coup for you in your career. And why don't you talk a little bit about that transaction?
So, actually, if you go back to the beginning, we started out like a lot of folks in opportunistic real estate, buying individual assets and doing portfolios. And I'd say the turning point in our business really came in 2004. At that period of time, we bought a company called Extended Stay America, and we began to see the benefits of using CMBS to buy large companies, the quality of the real estate we could buy, and the opportunity with some of those companies. And we went on to buy Prime Hotels and Boca Resorts, and we ended up going to Maristar and La Quinta, EOCAR, Trizec, and ultimately EOP. And one of the things we were finding out during that period of time, as we all recall, is lots of capital was coming into the real estate business, and it was driving up prices very high. And so we concluded that we could buy property more cheaply on the screen than we could on the street. And that's what the evolution was. Now, even though we could buy it cheaper, it still didn't feel like great value. We were generally, in our business, what we try to do is buy hard assets at a discount to replacement cost. That's what our focus is. And we thought, well, we could buy these big companies, but the other thing we could do is sell off a large chunk of them. And we started doing that first with a few of these hotel businesses, and then over time with some of the office businesses. And Equity Office was just a continuation of a strategy that had been going on, and we had a pretty good sense of where the end market was. I don't think we thought we were any smarter than Sam, but we thought we had a really good understanding of where liquidity in the marketplace was, and that if we bought this whole company, we could sell off large portions of it and hold on to assets we liked, in particular on the coast, at significant discounts to replacement cost and fair value. And obviously it took a lot of execution risk to do it, but that's what the strategy was. As the bidding war went on with Vornado, we ended up deciding to sell more. So ultimately we sold close to $30 billion of assets prior to the window closing in that summer of 2007. So I think it was good fortune in the sense that we moved very quickly after we bought the company to sell off large portions of the assets. But if you go back over time, if there was one thing that connected everything, is this basic idea of buying hard assets at a discount. So even though the business grew from the early deals in the 90s where I bought a $6 million shopping center in Great Bridge, Virginia, to buying a $39 billion U.S. office company, the basic premise is, well, these office buildings cost, $550 a foot. My net basis is going to be, after I sell down, $400 a foot, or whatever the exact numbers were. So that stayed constant, and in fact, when we bring it forward to today, oftentimes when we're buying debt to get control of properties, just like buying public companies, we're always looking at what's our underlying basis in the assets.
You had to be tempted to think about keeping New York as opposed to something else because of your such big pull on New York, that it had to be sort of a struggle. You had to lay the stuff off, but yet New York was, you knew 10 years later it would be worth more, right?
Yeah, New York and San Francisco. In my heart of hearts, I would have preferred, but once the bidding got going, we had to make a decision. Look, how can we still set up an attractive investment for our investors and generate a favorable return? And at that point, the cap rates in New York had gotten very low. The prices per square foot were quite high. And we said, look, we could still end up with a great West LA portfolio, a great Boston portfolio, a few buildings like 1095 6th Avenue in New York, and then a great Northern California portfolio at San Francisco. So we made some sacrifices. In retrospect, what we did was the right decision. I'd love to say we had perfect clarity. We knew what was going to happen. We didn't. We were just trying to execute the same business plan we've been doing for a long time.